If you are acquiring or entering into a capital arrangement with another business, or are considering an acquisition, merger, or joint venture, ensuring that you have undertaken proper due diligence is critical, and that includes due diligence of the target's tangible and intangible assets. Today, intangible assets account for over 87% of company value. However, when we look at due diligence conducted by many major law and accounting firms, the majority of time is spent focused on tangible or fixed assets. This is ironic given how little of company value today is actually attributed to these assets. With very little attention directed towards intangible assets during many due diligence processes, we find that when we are brought in, we're frequently asking questions that nobody else has asked. For example, in virtually any transaction, one of the parties will be asked to warrant that they own their assets. This includes all the company's assets, not just the physical ones, but also the intangible assets. Yet we know from looking at over 1,000 client engagements we have completed that 8 out of 10 companies are unable to prove that they own their intangible assets. Intangible assets are by definition intangible. They have no physical presence. Under accounting standards, they are generally off balance sheet, and except in the case of some registered rights, such as patents or trademarks, are often never recorded anywhere. Most companies cannot identify what their intangible assets even are. This is an enormous but hidden issue. If 87% of all company value is now in intangible assets, these are exactly the assets you most need to establish chain of title to, but it is also precisely these assets most companies struggle to prove they own. Imagine you were acquiring a business for 100 million. Unless this business is a pure real estate play, it is likely to include intangible assets worth at least 85 million. Yet there's an 8 in 10 chance that the business that you're acquiring cannot even prove they own those 85 million in assets. If you were acquiring a building for 100 million and the owner was unable to prove to you that they owned that building, your lawyer would never allow that transaction to go through. But this is what happens every single day with intangible assets. To avoid this situation, directors and management teams need to establish whether they are asking the right questions during the due diligence process and if the right assets are being assessed. All too often, we see intangible assets overlooked during M&A, JV, and exit processes, which means that significant risks and opportunities are overlooked. This results in a reverse Pareto scenario, where many companies that acquire other businesses focus 80% of their due diligence efforts on the 20% least important assets, i.e. the physical and tangible assets, when the emphasis should be reversed. Companies should in fact spend 80% of their due diligence efforts focused on intangible assets, the data, the software, the brands, the regulatory approvals, their networks and relationships, the confidential information, and industrial know-how. These are typically the most valuable assets of the business, but they are also the most frequently overlooked assets in traditional due diligence. That's a major problem.